Have you ever seen this small piece of plastic used to make purchases and wondered exactly how that works? Where does the money come from? What happens in the background? And is it actually good or bad for your finances? Today, we're breaking down everything you need to know about credit cards, from the absolute basics all the way to the strategies people use to make credit cards work in their favor. Whether you've never owned one, you're thinking about getting your first, or you've had one for years and want to understand it better, this video is for you. In this video, we'll break everything down into 7 simple sections, starting with what a credit card is, how interest and APR work, what credit limits are, how credit scores work, the different types of credit cards available, important fees to watch out for, and we'll finish off with going over some smart habits to ensure that you use your credit card wisely. So, stick around. This is the personal finance foundation most of us were never taught in school. Let's start at the very beginning. A credit card is a payment card issued by a financial institution, usually a bank or credit union, that allows you to borrow money up to a set limit in order to pay for goods and services. The key word there is borrow. When you use a credit card, you're not spending your own money right away. You're spending the bank's money, with a promise to pay it back, usually by the end of each billing cycle. This is the fundamental difference between a credit card and a debit card. A debit card pulls money directly from your bank account. Meanwhile, a credit card is essentially a short-term loan, every single time you use it. Now here's something most people never think about. When you swipe your card, there are actually 4 parties involved in that transaction. Let's meet them. First, there's you, the cardholder. You're the one making the purchase and agreeing to pay the bank back. Second, there's the merchant, the store, restaurant, website, or service you're buying from. Third, there's your issuing bank. This is the financial institution that gave you the card. They're the ones lending you the money. Think Chase, TD Bank, Capital One, Scotiabank, or your local credit union. And fourth, there's the card network. This is the infrastructure layer. Visa, MasterCard, American Express, and Discover are card networks. They're the middlemen who process and route the transaction between banks. In under 2 seconds, all 4 of these parties communicate, the merchant gets approval, and you walk away with your coffee. Pretty remarkable, honestly. Okay, let's follow a real transaction from start to finish. Say you're at a grocery store, and you tap your card to pay $80 for your groceries. Step 1. Authorization. The moment you tap, the merchant's point-of-sale terminal sends a message through the card network, say Visa, to your issuing bank. The message basically says, "This person wants to spend $80. Do they have the available credit? Is the card legitimate?" Step 2. Approval. Your bank checks your available credit limit and verifies the transaction looks legitimate. If everything checks out, they send back an approval code. And this all happens in about 1 to 2 seconds. Step 3. Clearing and settlement. The next part happens in the background, usually over the next 1 to 3 business days. The merchant sends the day's batch of transactions to their bank, called the acquiring bank, which then sends them through the card network to your issuing bank. Your bank actually transfers the funds, and the merchant receives their money, minus a small processing fee. Step 4. Your statement. All those transactions get logged to your credit card account. At the end of your billing cycle, usually monthly, you receive a statement showing everything you spent and a minimum payment due. So, you might be wondering, who pays for all of this infrastructure? The answer? Mostly merchants. They pay what's called an interchange fee, typically between 1.5% and 3.5% of each transaction. This is why some small businesses ask for a minimum purchase when you use a card, or even offer a cash discount. The fees add up quickly for them. This fee also funds your rewards. When a merchant pays 2% in interchange, part of that goes to you as 1.5% cashback or travel points. You're essentially being paid a share of the merchant's processing cost. More on rewards in a bit. Here's where credit cards either work beautifully for you or start costing you money. Most credit cards have something called a grace period. This is a window, usually between 21 and 25 days after your statement closes, during which you can pay your full balance without owing any interest. If you pay in full by the due date, every single month, you never pay a cent of interest. The credit card is essentially a free short-term loan. But, and this is a big but, if you only pay the minimum or you carry any balance forward, the interest kicks in. And credit card interest is brutal. APR stands for annual percentage rate. It's the yearly interest rate charged on your outstanding balance. For most credit cards in North America, this sits somewhere between 19% and 29%. The average in the US and Canada hovers around 20 to 22%. That might sound abstract, so let's put it in real dollars. Say you charge $3,000 on your credit card, and you only make minimum payments of about $60 a month. At a 20% APR, it would take you roughly 6 to 7 years to pay off that balance, and you'd pay over $2,000 in interest alone. You'd essentially pay for that $3,000 purchase twice. This is why understanding interest is so critical. Credit cards are an incredible tool when paid off monthly. They become one of the most expensive forms of debt when balances carry forward. Credit card interest isn't calculated annually, it's calculated daily. Your APR is divided by 365 to get a daily periodic rate. If your APR is 20%, your daily rate is about 0.055%. Each day you carry a balance. That daily rate is multiplied by your outstanding balance and added to what you owe. This is compound interest. Interest on top of interest. And it's why balances can grow surprisingly quickly if left unchecked. One more thing. Once you carry a balance, your grace period disappears. New purchases start accruing interest immediately, not at the end of the cycle. This is the trap many people don't realize they've stepped into. Every credit card comes with a credit limit, the maximum amount you're allowed to borrow at any one time. Limits can range from a few $100s on a starter card to tens of thousands on a premium travel card. How does the bank decide your limit? They look at several factors: your income, your existing debts, your credit history, your credit score, and how long you've been managing credit. Essentially, they're asking, how likely is this person to pay us back, and how much can they comfortably handle? Over time, if you use your card responsibly, most issuers will offer to increase your limit. This can be a good thing, but it requires discipline, because a higher limit means more potential debt if you're not careful. Your credit utilization ratio is the percentage of your available credit that you're currently using. If your limit is $5,000 and your balance is $1,500, your utilization is 30%. This matters because credit utilization is one of the biggest factors in your credit score calculation, typically accounting for about 30% of your score. Most financial experts recommend keeping utilization below 30%. Under 10% is even better if you're actively trying to build or improve your score. This is actually why getting a credit limit increase can help your score, even if you don't spend more. If your balance stays the same but your limit goes up, your utilization ratio drops. Let's talk about credit scores, because your credit card behavior is one of the biggest influences on this 3-digit number, and that number affects your ability to rent an apartment, get a mortgage, finance a car, and sometimes even get a job. In the US and Canada, credit scores typically range from 300 to 850 or 300 to 900, depending on the model. A score above 720 is generally considered good. Above 760 will get you the best rates on loans and mortgages. The 5 main factors that make up your credit score are: 1. Payment history. Did you pay on time? This is the biggest factor, making up about 35% of your score. Even one missed payment can drop your score significantly. 2. Credit utilization. As we just covered, how much of your available credit are you using? Making up about 30% of your score. 3. Length of credit history. How long have you had credit accounts open? Older accounts help. This is about 15% of your score, and it's why financial advisors often say, don't close your oldest credit card, even if you rarely use it. 4. Credit mix. Do you have a mix of different types of credit? Cards, car loans, a mortgage? Lenders like to see you can handle different types responsibly. This is about 10% of your score. 5. New credit inquiries. When you apply for a new card or loan, lenders pull your credit, creating a hard inquiry that can slightly lower your score temporarily, making up about 10% of your score. Used wisely, a credit card is one of the most powerful tools for building credit. Pay on time, keep utilization low, keep old accounts open, and your score will thank you over time. Not all credit cards are the same. Let's run through the most common types you'll encounter. Rewards cards. These give you points, miles, or cash back on every purchase. A cash back card might give you 1% to 2% back on everything, with higher rates in specific categories like groceries or gas. Travel cards typically earn airline miles or hotel points. If you pay your balance in full monthly, rewards cards can offer genuine value. Secured cards. Designed for people with no credit history or damaged credit. You put down a security deposit, say $300, and that becomes your credit limit. The card reports to the credit bureaus just like a regular card, so you can build credit while keeping the bank's risk low. Student cards. Lower limits, simpler rewards, easier to qualify for. Built for younger people just starting their credit journey. Balance transfer cards. These offer a 0% introductory APR for a set period, often 12 to 21 months, specifically for transferring existing debt from other cards. If you're carrying high-interest debt, a balance transfer can save a significant amount in interest. But watch for the transfer fee, usually 3% to 5%. Business cards. For small business owners and self-employed individuals, often come with higher limits, expense tracking features, and rewards tailored to business spending categories. Premium and luxury cards. High annual fees, sometimes $500 to $700, but loaded with perks: airport lounge access, travel credits, concierge services, comprehensive insurance. Cards like the American Express Platinum or the Chase Sapphire Reserve fall into this category. They're worth it only if you use enough of the benefits to offset the fee. Let's cover the fees you'll encounter, because understanding these is crucial to using credit cards smartly. Annual fee. Some cards charge a yearly fee just for having them, ranging from $0 on basic cards to $700 plus on premium ones. Always make sure the benefits outweigh the cost. Interest/finance charges. As we discussed, these kick in when you carry a balance. At 20% plus APR, these can add up fast. Late payment fee. Typically $25 to $40 if you miss your payment due date. Beyond the fee, a missed payment can seriously hurt your credit score, and some banks will revoke your promotional interest rate. Over-limit fee. Some cards charge a fee if you exceed your credit limit. Most modern cards just decline the transaction instead, but check your card's terms. Foreign transaction fee. usually 2.5% to 3.5% on purchases made in foreign currencies. If you travel internationally, look for a card that waives this fee. Paying it adds up quickly. Cash advance fee. Using your credit card to withdraw cash from an ATM is almost never a good idea. You pay a fee of 3% to 5%. There's no grace period, and interest often starts accumulating immediately at a rate higher than your regular APR. So how do you actually win with credit cards? Here are the habits of financially savvy cardholders. Pay your full balance every month. This is rule number 1. If you can't commit to this, be very careful about carrying a card at all. Set up autopay for the full statement balance, not just the minimum, so you never miss it by accident. Know your billing cycle and due date. Mark it on your calendar. Missing your due date is one of the most damaging and easily avoidable mistakes. Keep utilization below 30%. Track your balance. If you're a heavy spender, you might want to make payments mid-cycle to keep your reported utilization low. Only apply for cards you need. Each application triggers a hard inquiry. Don't apply for multiple cards in a short window. It signals financial stress to lenders. Use your card for everyday spending, not debt. Credit cards are best used as a payment method, not a borrowing tool. If you wouldn't buy it with cash, think carefully before putting it on a card. Review your statements. Look at every line item. Credit card fraud is common, and catching unauthorized charges quickly limits your liability. Credit cards are genuinely powerful financial tools, but they're powerful in both directions. Used well, they build your credit history, earn you rewards on spending you do anyway, and give you a buffer in emergencies. Used carelessly, they can trap you in high-interest debt that's surprisingly hard to escape. The difference almost always comes down to one thing: whether you're paying your balance in full each month. If you're new to credit cards, start simple. A no-fee card, small limit, one purchase a month, paid off in full. Build the habit before you build the limit. If you've been carrying a balance, the best move you can make today is to make a plan to pay it down, starting with the highest interest card first. Every dollar of interest you avoid is $1 back in your pocket. And if you found this video helpful, I'd really appreciate a like and a subscribe. It genuinely helps this channel grow, and I've got a lot more daily life content coming that I think you'll find useful. Drop a comment below if you have questions, or if there's a specific credit card topic you'd like me to cover in more depth. Thanks so much for watching, and I'll see you in the next one.